Okay, so I wanted to review some of the highlights from chapter 11 here, um, starting with the difference between investing and speculating. Okay, uh, investing, just sort of your understanding, it is something that's very long term. So, in the long run, as you saw that in the slideshow from the last class, in the long run, investors do pretty well, right? Particularly those that have gone into the stock market, they've done really well. But as you also notice, it's taken a lot of time, taken a lot of time. And so it's important to look at investing as a long-term process. Okay, it is in essence on future benefit. What you've been seeing a lot of is speculation. Speculation is not investing as so much as it's placing a bet. It's much more like gambling than it is investing because the long term um, is not in the picture. It's really sort of short term that's in the picture. So I want to run up. I want to get on the ride of the stock price as it goes up, and then as soon as I think it's done, I'm getting out. Um, that's speculating, right? And there's a lot of that. That's part of the market. It just happens to sort of understand that it's part of the market. Sometimes it gets sort of glorified a little bit when people tend to sort of hit the jackpot when they're day traders and they're making a lot of money. But just understand that it's more like gambling than it is investing. Investing is a long-term game, and speculation is a short-term game, very short-term. Could be for the next few hours, could be for the next couple of days, um, but it's different than investing. Okay. One of the things that's very, very important to understand is how do you feel about risk? How do you feel about risk? Because if you are what this says risk averse, which means you don't like risk, then you certainly want to stay away from anything that is speculative, right? Because that involves the most risk, is all those speculative things. So, what's speculative, and a lot of people have been getting into, you might be hearing a lot about buying gold or silver. That's speculation. That's speculative because there is a market for gold and silver. It's used for jewelry. It's used for certain products, be it military or other. So there is a market for gold. There's a market for silver. There's a market for all those types of things. Um, but it's not a huge market. And so the rest is actually looking at gold, silver, other types of things as a way um, to bet that things might go bad, and so I'll be safe with gold or in my pocket. That's speculation. That's speculation, and it actually is extremely risky. It's extremely risky because it's not based on the actual need or growth of the use of the product. It's actually based on other things happening, and thus it becomes a value. I think all the cryptocurrencies are sort of based on that as well at this point, because every currency, whether it's the US dollar, any other dollars that are, it's the euro or other types from other countries, they are actually printed and backed by their government. Okay. So when you look at your dollar bill, it'll say a Federal Reserve note, and it'll say printed right on it, this can be used for all debts, public and private. And it's the government that prints it. And there's nothing behind it. There's no gold behind our dollar. There's no precious metals behind our dollar. It's simply the word of the government that a dollar is a dollar because it'll buy you a dollar's worth of stuff. They promise. So it's actually based on a promise that the currency has value. And that promise comes from the government itself. So as long as the government backs up the dollar, it'll always have value. Once they stop backing it, then it becomes highly speculative. So all the currency is what we call fiat currency. It's not backed by any asset other than the promise of the government that it's worth it. So cryptocurrency is not issued by a government, right? It's just issued by whoever started. And part of the problem with the cryptocurrency, why it's so it's interesting. It might be something in the future that we could use. It's actually being used right now as a medium of exchange, so it's looked at similarly as money. But it's highly risky. It's highly speculative because who's to say what the supply of that currency will be? And if it's owned by a company or a group of individuals, can they just change the amount? And will that then change the value? Um, and so it's a risky business at this time. It might develop into something that's less risky in the future, but at this point in time, it's significantly risky. So a lot of people have been buying Bitcoin, or that's just it's just betting. You're at this point, it's all speculation. It's possible it could work out. It's possible it could collapse. Um, that's the problem with it. Um, I think a lot of there are marijuana companies that have stocks. I know if you are into Acorn or Robinhood or something like that, one of the options that you can invest in is a stock like Aurora Cannabis, for example, which is a Canadian company, it's a real company in Canada that has a good market in Canada. Um, but right now, it's based. It's all speculation that this is going to be growing to a worldwide type of thing. It might not, um, because governments have to be on board. Right now, even and one of the problems and the risks in even having a marijuana-based company in the states is that federal law says marijuana is illegal, and thus no banking institutions can participate. And if you don't have a bank, where do you deposit your money? How do you pay bills? How do you do other? And that's the problem with some of these businesses right now, is they're sort of up in the air. We're in the midst of this change, and eventually it might be legalized, and banks could participate. But at this minute, at this point in time, these companies are highly speculative. And even though if you're really hot on marijuana, in other words, it's a smoking idea, um, it's still a very risky idea because it is something that is not yet established per se, and it makes it very difficult to do business. Even those that are in medical marijuana, it's still very difficult to do business in the states because federal law still looks at it in one way, states are changing it in another. Again, before investing, you want to make sure you understand how risk averse you are. If it's okay that you wake up one morning and $1,000 is missing from your account because your investments went down, and you're okay, that's fine. Then maybe you're not so risk averse. But maybe if you even lost $10, you'd be crazy. Oh my God, my money's going away. I can't afford to lose any money. Well, then you're risk averse. You can't be doing that. So knowing the type of person you are regarding risk is one of the most important things to understand before you invest. Before you invest. And investing comes after the fact that you have an emergency savings account and you have enough insurance coverage for various things. So investing actually comes after those types of things. It doesn't come before. Okay, it doesn't make any sense to start investing if if you don't have any savings or you're still spending more than what you make. Then it's never going to work out for you. So I wanted to point that out because that's an important part here. How you get started is there's a lot of options for you, actually, believe it or not. One of the things that people do is they commit to an automatic investment program. So they might have an account with a mutual fund company um, or a brokerage company to some degree, and then every single month a certain amount of money is taken out of your checking account, put into the investment account for investing, and it's done that regularly. Another thing that people do is once they actually have investments, whatever dividends or interest that that investment has is just put back into more shares of the investment. And thus it builds. Then your dividends are earning dividends, your interest is earning interest. And this is how wealth is built over time. But it's really important to understand that you do have some options. Okay, you do have some options, and we'll see that. Financial planners actually help in designing an investment plan based on your risk level, your tolerance for risk, and how risk averse you are, or you just throw everything to the wind and you don't really care so much. And whether you're actually putting in a big amount right now, or you will, like I said, periodically, every month make, or every week put a certain amount into an account and start building wealth slowly over time. So it really depends. It really depends on what your strategy is. Again, we looked at this is actually a longer period of time, and we're looking at bonds and the S&P 500, which represents the stock market average. And so for a 5-year, 10-year, 15-year, and 91-year period of time here, you can see that stocks have uh, continually outperformed the other, in this case, bonds, investment types. And so basically speaking, being an owner, which is what stocks is, has paid off more than being a lender over the long run. Over the long run. And again, it really depends. Notice how, depending on the time period you look at, the returns on all the investments are different because, of course, what happened in the last 5 years has been a pretty good run up by the stock market. And so you have very high returns by the stock market. But if you look at what happened during the period of time that there was the crash, right, then you'll see that those numbers have been affected a great deal, right? Because when the stock market comes crashing down, the averages for stocks go down. But over the long run, it's done quite well. It's done quite well, and I showed you that in the other slideshow as well. Okay, so what is your objective? Why is it that you want to invest in the first place? That's one of the most important questions that you want to ask. For folks who are older and retired, what they really want is more income, steady stream of income coming in. So in addition to perhaps their Social Security checks and any pension plans that they might have, or any private savings they might have, they want to make sure that the investments that they do have provide them with yet even more money per month, because that's what they need now. They're not working. They want extra cash every month. So current income might be an investment objective. You might want to save for a major expenditure. You might want to have a down payment for a house, have a business, college education fund. That's an objective. You might want to start thinking about saving for retirement, which I really believe you should. The earlier you do it, the less amount of money you have to save up front, and it just grows exponentially. Retirement savings is a very good objective. You might want to lower your taxes. This probably doesn't apply to anybody here unless you start making well up into the six figures. So I'm talking, $400,000, $500,000 or higher per year in income. Then you're looking for different shelters. Of course, you can look for shelters when you're less than that, but there's more. There's more places to hide when you make a lot more money. And you should have a stated plan, and that's important. because that is really going to help you. So again, what is your goal? What's the objective? Everything starts with a goal, and that's where you start. Of course, you learn what type of an investor you are, your approach to risk, and then what's the goal. And then, of course, there are lots of different ways to invest, investment. We talked a little bit already about stocks and bonds. There are different types of stocks and bonds. That's what a preferred stock and a convertible bond is, just a different type of stock and bond, but it's still stocks and bonds. We'll be focusing a lot, particularly next week, on mutual funds, exchange traded funds. ETFs are very, very important. Of course, there are other loans or exchange traded notes that are there. And some people want to purchase real estate as an investment. A house is not an investment because everyone needs a home, and we've gone through that. But some people want to buy an income property. They want to buy an apartment building or want to buy a 2 or 3 family house and rent it out as a business. So in this case, that's what they're talking about here. Okay, not your normal home, but real estate as an investment. Mm-hmm. So we talked a little bit about this in our last class, but basically, common stock represents ownership in a corporation, and in our case, it's a public corporation. Right? And so this is what your book talks about. We really want the stock price to go up. Sometimes there are dividends that are paid along the way, and again, that's a plus. Bonds, as we talked about, are loans. The loans can be to government, to corporations, but these basically, the corporations are paying interest to the bondholder every 6 months until it's due, in which case they pay you the whole thing back. One bond is $1,000. Okay, so every single bond that's sold is $1,000 investment. Now, here's a couple of different ones. So they have something called preferred stock. Preferred stock is also ownership. But it's ownership that doesn't vote, doesn't have a say in some of the policies that the company would need stockholder approval for. And instead of actually getting that vote, they get something called a fixed dividend. So preferred stockholders actually get dividends first before the company or corporation can give it to common stockholders. So no vote, but you get your dividend up front. Okay. And so that is important. Preferred stock has some features to it. The company could pay back the stock early. And so actually preferred stock could be called, which is the same as you're going to get paid by the company early. Your investment's going to go away because the company's going to give you your money back. And that can happen almost any time. It's not a good feature. That can't happen with common stock, but it can happen with preferred stock. And of course, preferred stock can be, they have a convertible feature, which means that your preferred shares can be converted to common shares at some point. Not all preferred stock has that feature, but a lot of them do. The other is something called a convertible bond. A bond is a bond. It's a loan to a corporation. What this bond has is a feature that says, look, at some point during this loan, you can be a stockholder. So basically, a convertible bond gives the bondholder a right to convert the loan into something called certain shares of common stock. And that's why they call it a convertible bond, is because you can convert your loan to ownership in stock. Okay, so these are called hybrid securities because even though it's stocks and bonds, they can actually, usually bonds can be paid off quickly. That's a call feature on a bond. Preferred stocks in this case have that. And in terms of the conversion to common stock, that's a nice feature to have. You don't have to exercise it, but it is a nice feature to have. So again, these bonds and stocks are different than traditional stocks and bonds that we talked about. We're going to be spending a lot of time talking about mutual funds, all of chapter 13, in fact. But mutual funds are pools of investments that are geared towards certain areas of the investment field. You just have to pick which one you're comfortable with. They are professionally managed funds. You can get mutual funds that are just dealing with stocks and certain types of stocks, large company, small company, what have you, international. You can invest in a pool of money or a mutual fund that invests simply in bonds. And of course, even the types of bonds. There are some bond funds that specialize in government bonds, some that specialize in corporate bonds, some that specialize in municipal bonds, things like this. So it varies in terms of your feature. You can also have mutual funds that are based on other investments like real estate or things like this. So so there's lots of choices there when we get there. Mutual funds are very, very popular. They've been around for, believe it or not, over 100 years as a concept. But they really got popular in the 70s and 80s. Really, it's the 80s particularly really got popular with general investors. Electronic traded funds are sort of like a mutual fund, but you can trade them during the day. They basically are something that we'll talk a lot more detail about in chapter 13 when we talk about mutual funds, exchange traded funds. But they sort of act like mutual funds because they track a pool of investments or they track an index. Okay, we'll talk a little bit about that. The same is true for exchange traded notes. These are basically exchange traded bonds. They basically are bonds. So a debt security is a bond. Okay. And that you don't have to worry too much about right now. And again, I mentioned that real estate in this sense, you can purchase a home for you. That's not an investment. It's just your home. But if you want to have an income property, you can do that. You could also participate in commercial development. You can be a part owner in a commercial property. And so those are limited partnerships that are available for that. So, there's options. There's options there. And if you do invest in real estate, what you're getting is, you're hoping that the tax, the rent that you collect is going to be returned to you as the owner. There might be some gains on if you sell a building as an owner. And real estate has had a lot of tax benefits. So, in general. And so that's something that benefits owners of real estate specifically. All right, so a securities market, as your book says, is basically where financial instruments are traded. And so we're looking at specifically the capital markets in the US. We do have, as I mentioned, the money market, as is mentioned also in your book. You and I deal with the secondary market. Everything that you and I do, if we want to buy stocks or bonds or whatnot, it's a secondary market that we deal with. But there is something called a primary market, which is basically run through the investment bank. So when a corporation wants to raise money, either by selling stock or selling bonds to investors, they go to the investment banks. The investment bank underwrites those securities. And the investment bank often finds the money for the corporation that's seeking, whatever money there are. So investment banks actually tend to be, and their clients tend to be the first ones that buy or give the money to corporations. So they're the first ones in. They're the first ones in. The company that goes to the investment bank, they get their proceeds, they get their money, and they're gone. So now you have a bunch of investment banks and their clients that own all the stock or all these bonds, and they don't want to own it anymore. They want to sell it. That's what the secondary market's for. The secondary market basically is a market where you and I can buy shares of stock already owned by somebody else. And we can buy bonds from other people that already own bonds. So these are, this is the role of the investment banks. The investment banks are, I like to call them the fundraisers of capitalism. They do that through selling, helping companies raise money through selling bonds to investors or selling shares of stock to investors. They do also help municipalities raise money. What they don't help is the United States government. The United States government issues their own uh, bonds directly to the public through the Federal Reserve System. Okay. So the stock markets basically are all called secondary markets because whether it's the New York Stock Exchange or the NASDAQ, um, these are all markets that you and I, as potential investors, can buy shares of stock in through these markets. And when we don't want them anymore, this is the same market that we can sell them in. So that's the purpose of those markets. When we deal with the markets, it depends. If we can look at markets in two ways. The New York Stock Exchange is broker owned, so it's a broker market. The NASDAQ is set up by dealers, and so it's considered a dealer market. A broker market, basically like the New York Stock Exchange, you can actually see people, walking around the exchange there. And so what they say in a broker market is the buyer and seller of those shares are coming together directly. Okay. It actually happens through the brokers, but it's a direct market, they say. So that's the broker market. A dealer market is all computerized, all computerized. They just put it into this big computer system and the buyer and seller match up through the system. They never actually meet. And so that's that. The problem is that even in a broker market, most of the transactions are done electronically, where the buyer and seller actually never technically meet. But it's just the progress of technology that has changed all of that. And so here you have your your national exchanges, New York Stock Exchange, and the local regional stock exchanges that have existed for a long time. And then your dealer markets, NASDAQ and OTC, are your dealer markets. Those are basically the differences here. All right, and not to go into too much detail, but what you and I know the most of, or we hear a lot about, the New York Stock Exchange, is a broker market. It's New York and London are the biggest in the world. Tokyo is the third largest stock market in the world. That's a broker market. Okay. So stocks on these exchanges, in order to be part of a broker market and New York Stock Exchange, a company has to be pretty big, okay, in terms of sales, in terms of assets, before they can get traded on this type of an exchange. That's not true with the NASDAQ, as you'll see in a moment. And so, so stocks that are on the New York Stock Exchange basically make up this Dow Jones Industrial Average, and they make up most of what we call the S&P 500 index. Okay, the the Dow Jones Industrial Average is simply a index of 30 large companies from different areas of. They're the largest companies in different areas of different industries, but they only represent 30 companies. Okay, and they're the biggest. They're the biggest companies that we know. And so even though the Dow Jones Industrial Average is probably the most popular average that's posted on the news, the Dow is up today, the Dow is down today, you hear about all the time. It actually only represents a few companies, 30 companies out of, literally there are at least, I think, over 5,000 companies listed in general in all the markets. So it only represents 30. So it's relatively small, although they're huge. What's a better index, and that's why it's considered the market index, is the S&P 500. So these are the 500 largest companies that are traded in the market. And thus 500 companies tell you a lot more about the economy than 30 companies do. Okay. And so the S&P 500 index tends to be the one that's used to give you those averages. How did the stock market do this year? Well, they're looking at the S&P 500 index to give you that information. They're not looking at any other indexes. And believe me, there's plenty of indexes to look at because companies create them all the time. Financial companies create them all the time. But the S&P is considered the market index. So how the stock market do? And they say it's up 12% this year. It's the S&P 500 that they're quoting. So dealer markets are different in the sense that, it's just this huge telecommunications network. It started many years back, before more and more of the market has been in this New York Stock Exchange has been computerized over time. And so basically it works on a bid-ask system. People that are very interested in selling would offer that at a certain asking price. The people that are interested in buying would put in a bid for those types of things. The difference is what people are paying. Investors actually pay the ask price when they buy. They're actually paying that ask price. The investor who's selling actually receives the bid price. There's a difference between the ask and the bid, and that's the money that stays with the broker in the dealer. Sorry, the dealer in the dealer market. Okay, so that's how dealers make money in this exchange. The difference between these prices is basically sort of a commission to the dealer in the market. Okay. The NASDAQ is the National Association of Securities Dealers. Used to be automated quotation because it used to come out in a little ticker tape, and then spit out little symbols and numbers next to it and so forth and so on. All that confetti that's been used in, since World War II celebrations are basically all ticker tape, from the stock market that was shredded up. But the NASDAQ has been recognized as an official exchange. It has a part of the NASDAQ called the OTC market, which is regulated by the SEC, because any company that is traded on the OTC market needs to provide the government regular financial statements that have been audited. But also part of the OTC is a lot of small companies that are traded. A lot of you might have heard of the term penny stock or penny stock. Well, they trade on the over-the-counter market on something called the pink sheets. And this is where it's different than other companies. This is why it's more risky to do a penny stock, is because this is unregulated. They're not required to submit reports, the same types of reports, to the SEC. They're not required to submit for example, an audited financial statement. So the numbers that these companies provide could be true, could not be true. We don't know because there's no way of verifying the numbers because they're not audited. Okay. It makes for a risky market because it's people say, oh, my company went from 1 penny to 2 pennies, and so I doubled my money. Yes, try to sell it. You can own it, no problem. Try to sell them. I mean, that's one of the problems. It's just not widely available trading wise. Trying to sell these things, getting in is fine because there are people that are dying to get out. Kind of like a timeshare. Get me the hell out of this. So you can get in, no problem. It's getting out that's the problem. once you buy these things. There may not be that much of a market to let you out. And so it makes it extremely risky. It's extremely risky. So again, the SEC is the government entity established way back 1933 and 1934 that regulates the exchanges, the stock market, actually all securities market. And so the purpose is to help protect the investor by making sure that companies are giving very good financial information to investors. And thus investors will make that choice based on that. Okay. It's been buoyed a lot by recent reforms. Sarbanes-Oxley requires companies to do certain types of things to prohibit fraud or face jail time. And of course, the Dodd-Frank Act in 2010, after the collapse, also increased the reforms in the market and buoyed rights for investors. We talked a little bit about bulls and bears last time, but in general, it depends on whether stocks are falling or rising over time to be classified as either bull or bear. And your book mentions that, most of the last 50 years have been relatively bullish, except there have been periods, certain years that are listed here, that have been bearish. All right, so brokers, stockbrokers help. You need to deal with a stockbroker to buy and sell stocks, and because it's required. It's required. You can't just go up to the market and knock on the door. Hey, I'd like to buy some stocks. They're going to say, go through a broker, and that's because the brokers own the market. They own seats on the exchange, and so they are the only ones that can sell it and buy stuff for them. So they have to be licensed and they have to be members of the exchange in order to participate. Your book also mentions some differences between full service brokers and discount brokers. Basically, it's about services to clients. Full service brokers live on commission. And so they offer all types of brokerage services that are personalized for their clients: investment advice, investment information. Of course, they execute trade. They hold those stocks and bonds in the firm for the clients. They provide all types of services, including loans. So a client can buy shares of stock with a loan. It's called a margin loan. Discount brokers are different. They don't offer investment advice. They don't offer various things, but they do much of what a full service broker does at a much reduced cost. Okay. So if people are good at picking out their own stocks and they don't want to deal with a full service broker, they can just simply use a discount broker. And there's some examples there. And then, of course, almost all your online brokers are discount brokers. Good news for you if you do have a brokerage account. It's protected. It has insurance. The SIPC is insurance for your loss of securities or cash held at your brokerage firm, held at the brokerage firm. And so this is important. This is important, so investors know that there's some insurance on that. Works very similar to the FDIC for banks. So in order to trade, you need to establish an account with a broker. You need to put money in it. And then you can go ahead and buy securities as you wish. Types of orders that you would give include buying the stock at whatever price it's at, the best possible price. Yes, absolutely, yes. The question was, does Fidelity have that interest? Yes, all brokers do. So a market order basically is buy the stock at the best available price right now. So as you know, the stock market's open from 9:30 in the morning to 4 o'clock in the afternoon, and anything can happen during the day. where the stock prices change minute to minute, hour to hour. So what you're saying with a market order is, look, I want to buy the stock now, get it at the best price for me. And so that's what they do. You can also put in what's called a limit order. A limit order basically is that you want to buy a stock, but at a specified price or better. So buy Apple at $105 or lower or better. Right now it's at 120. So you're gonna have to wait a while if it ever gets down there. So so that's a limit order. It's a limit order. And then there's something called a stop loss order, which means that you want to sell the stock if the price collapses at to a certain price. Thus, you limit the loss that you have. So let's say, and this happened to Tesla. Tesla was at one point almost $1,000 a share. It's now back down to, I think, $300 or $400 a share. So at one point in time, it did collapse. Right? The price went down rapidly. And so what you can say, if you purchase Tesla at $900, you can put a stop loss order and sell, if the stock collapses behind below $800, get rid of it. I don't want to own it anymore. Okay, 438, great, thanks. So if the stock price dropped from 900 down towards 800, down towards 700, a stop order loss would sell the stock at that price on the way down. So in essence, it would limit your losses. This is good for the investor, but it's bad for the market because these stop loss, all of these orders are put in the computer. The computer doesn't have any feelings one way or the other, but the computer will just start executing things as in the order that they have. And it doesn't know when to stop because it's a computer. It's just ordered to process stuff. And so this accelerates downward pressure on stock prices when the market goes down. And this accelerates upward movements in the stock market, which is why you should never look at any one particular day, the market's up 100, down 100, up 1,000, down 1,000, as any big deal. It's better to look at the trend over the last year, over the last 5 years. What has the market done? That's a better way to judge whether it's a good idea. In terms of Clark's question about how long these orders last, you can put them in for the day if you want it just for the day. You can put it in until filled. You can put it to a certain day if you want it to expire on a certain date, or you can actually just leave it there until it's filled at that price. So you have some choices. You have some choices there. The rate of return is important because a lot depends on the price that you sell it at when you're done. So the ending value, the money you have here, you subtract out obviously the beginning value, what you paid for it, plus any income that you might have made. And then divide that over where you started. And that gives you your rate of return. So here's a quick example. Investment return, say you bought 100 shares of Disney at $101.60 a share. So 101.60 is the price for one share of ownership. That's what this means. When it's quoted per share, it's simply one share of ownership will cost you that much. The stock is currently selling at $112.02. Over the course of the year, you held this stock. Disney paid you a dividend of $1.68. So what's the rate of return? Okay, well, the rate of return is the ending value. So you have $112 stock right now, okay, and you bought 100 shares of it. So 100 times that is what this number is. So that's the selling price. You're subtracting out what you paid for it. You paid 101.60 times 100 shares. So you're subtracting out what you paid for it. But you got to add in the fact that you got a dividend. That's money that you earned. It's $1.68 per share. You have 100 shares. So you add that back in. So whatever the product is here, you divide that over what you paid for it. which is this number right here, 10,160. So that meant that this particular company returned a 11.9% return on your investment for that particular year. Okay. And I think that's all. Yeah. Okay. So there's sources of information for you as investors. Lots of different things that you can find out about a company. You're going to find at least one of those questions on the test, yes, which is why I reviewed it. Yeah, so that will be something, and it might just be one or two. Like I said, when I give module exams, I'll often throw a few of these things from the different chapters in, but it won't be. It's like not a full test that's fully on that, but it will certainly. Rate of return is important to know as an investor. So annual reports are always around. Company websites. The SEC, of course, keeps all track of that as well. They have a database for that. Any of the newspapers that usually follow these types of things. So you have Wall Street Journal, Barron's. Of course, you can even do various things like even Yahoo Finance usually tends to be pretty good. There's data on every company, lots of reports there. There's news on every day on different stocks. You can look up. Of course, you can look up stock quotes and get more information. And of course, you can buy advisory services as well. So I'm going to stop there for today. Is there any questions so far? A lot of good questions so far, actually, but any additional questions?